you for joining us on Power Lunch on Bloomberg Quint. I'm Ira Dougal. Let's get straight to the headlines. The Nifty hovers around the 9,900 mark as investors take a breather after 4 days of gains. Bad loan resolution remains one of the biggest challenges, says SBI Chairman Designate Rajneesh Kumar. Adds the bank is in a better position to assess risk now. KKR India chief tells Bloomberg Quint that it remains interested in the stressed asset space in India. The private equity major is still awaiting its license for an asset reconstruction company. Companies did not cut back on production but chose to dispatch less in the June quarter, says Adi Godrej, adding that he's confident that growth will pick up in the second quarter. And Pratap Snacks listed a premium of more than 30% on the Bombay Stock Exchange. All of those stories coming up over the next half an hour, but let's take a look at how the markets are faring. Agam Vakil is joining us with a complete roundup of the equity action. Agam, what's it looking like?
Well, absolutely flat amid very average turnovers. We really aren't looking at too much momentum in stocks. Among the key gainers, we are keeping an eye on Aurobindo Pharma, HCL Technologies and Yes Bank. In losers, we have some weakness building in Infratel as well as Tech Mahindra. In terms of the broader markets, when it comes to the market breadth, we are looking at 3 gainers for 2 losers. But what also stands out is in the sectoral indices, there are very few gainers or losers for that matter. In fact, moves are less than 0.5%. The realty index, which stands out with gains of nearly 0.9%. On the other hand, on the losing end is the PSU banks, which are looking at moves of less than around 0.7%. So absolutely flat in the mid-cap space too. It's only a couple of IT stocks which are gaining. So we have the likes of 8K Miles and Intellect Design Arena moving up by as much as 8.5%, but otherwise really not too much to talk about.
Right, Agam, we'll come back to you on one of the stock-specific stories in a bit, but that's the macro picture on the market. Before we get into stock-specific stories, let's talk about the big macroeconomic trigger that we're all been trying to assess, and that's the implementation of the GST. Now, going into the implementation, rating agency India Ratings had forecast that there would be some amount of working capital challenges that would emerge, particularly for micro and small and medium enterprises. They put an update on that report. With me in the studio is Menka Doshi with the key takeaways and some analysis of what they're saying, Menka.
Ira, exactly as you pointed out, they've put an update to the report where they've been able to quantify some of the working capital impact on certain specific industries. So effectively, they've said a 200 to 450 basis point impact of revenue. This is 450 basis point of revenue. For the steel industry, 500 basis point of net value addition across the value chain for the textile industry. These clearly do seem to be the ones that will be hit most by this working capital crunch. Like you pointed out, small and medium enterprises obviously stand to suffer more than the larger ones that can access bank credit and therefore tide over their working capital problems. They've also outlined some of the positives and negatives for certain specific sectors, such as why power is going to face a difficult time. So let's get down to some of the specifics with the author of this report, Neeraj Rathi, Associate Director at India Ratings, joining us now to talk us through the quick takeaway. Neeraj, you all had anticipated that there would be a working capital challenge due to the implementation of GST. Is it much worse than you had anticipated? And how are companies, the smaller size ones, able to fare with this? Are they coping well at this point in time?
No, we had anticipated this earlier, but then as we get into the implementation phase or cross the implementation phase of this, the challenges have increased largely also on account of the technical issues which one is facing while with the GST, and that's the IT backbone of GST implementation. So that has in fact aggravated the challenge. So some of the small size entities would actually find it very difficult to fund the gap. Also given that the timeline now to get the input tax credit could be that much more longer.
Fair enough. You've said that it's the manufacturing sector that will be hurt the most. Specifically steel, textile, auto and auto ancillary. And then you've also gone on to outline the impact, not just of working capital needs, but otherwise as well on the construction sector, on engineering, procurement and construction contracts, and on power. You want to talk us through very quickly the negative impacts on each one of these sectors?
For manufacturing sector in general, now the sector would be paying GST at a rate which would be higher than what they were paying at the factory gate. For example, if steel's excise duty payment at the factory gate was about 12.5%, now they would be paying 18% at the factory gate. And on top of it, warehouse movements are also getting taxed for most of the manufacturers who would be selling their product outside their production state. So that warehouse movement would also get taxed should they choose to move goods to their warehouses. So that's the theme which would play out for the manufacturers. Their overall tax outflow would increase because now goods would be moving tax paid and also
let me get a little bit more specific about the impact on power plants, because I think you've been able to quantify really what it means for power, especially since electricity has been left out of GST.
For the power plants, those who are actually implementing power plant or erecting power plants or power producers who would be going through this capex cycle, their cost of implementation would be higher now. Mainly because most of the power plants were operating or procuring goods from outside their state, and that was on a CST of 2%. While there is no CST concept under the GST regime, the entire power producer network would be paying higher tax rates, and that would in fact add to their cost because there would be no output tax liability which they can set their input tax against.
Okay. For engineering, procurement and construction contracts, you pointed out that the GST rates are higher and that this will increase project cost. Have I understood that correctly?
Yes. There is a catch there in the sense that if most of the construction contract projects would have a change in law clause. Now, if that change in law clause is effectively implemented, which means any cost escalation due to GST regime might be passed on to the consumer or by the contractors, which means for their principals, then they would not be facing significant challenges. But there are certain contracts which are signed on a gross tax basis as well, for which if the rates are not negotiated, then the entire hit would be taken by the construction contractors, and that would be a significant dampener for them.
Okay, one final question. If you could give me a brief answer, I'd appreciate it. Yes, of course, we understand that small and medium-sized enterprises would find it really tough to be able to access additional working capital. But are you seeing enough stress for you to worry from a credit point of view?
For the smaller entities, again, I would be more worried for the construction segment, given the nature of their operation. They were working under a regime where they were not subjected to taxes. They were working under a composite tax regime earlier,
right,
and now they have been transferred to GST. So that is where I would be more worried.
Okay.
Otherwise, some of them would be able to fund it through their own sources or at a higher cost of borrowing, but then they would be able to tide over this.
All right. Thank you so much, Neeraj, for joining us today. Sort of echoing what Sanjay told us in the morning today about his NBFC operations and the fact that so many companies are coming to them for working capital assistance, right?
Yeah.
And that was going to be the tough thing as they sort of went through the first 3 to 6 months of GST and figured out how to make all of this work in good time.
Yeah, so I think the good news is that the NBFCs are there to provide the working capital credit. The bad news may be that they are a little bit more expensive than, and it adds to the cost.
We'll start seeing this factor in, and even if it's one time or over a couple of quarters, it comes at a time when earnings growth has not been
great.
Yeah, so I suppose that's the worrying point. Anyways, on Monday we will be celebrating 100 days of GST across the country and also on Bloomberg Quint. So we'll get you a lot more analysis on the impact of this landmark tax system on that day.
Thanks, Menka, for that. That's the GST picture. Let's get into stock-specific stories. The board of Future Retail will consider fundraising plans today. Reports suggest that some of that money could go into an acquisition. Agam Vakil is back with us. Agam, what's the story playing out there? The stock's flat?
Yes, well, what we know with respect to Future Retail is that they will hold a press conference today at 4 o'clock, and they are going to make an announcement. And as news reports suggest, that this announcement is most likely to do with their acquisition of Hypercity, which is a subsidiary of Shoppers Stop. This acquisition is likely to be made, according to that news report, for around 700 crores, and this comes down to around 19 stores. Now, I did run a few numbers, and when it comes to financials for Hypercity, well, it's generated revenues worth around 1155 crores for FY17, but it is operationally loss-making, albeit we have seen those losses narrow. But if you compare them and run it against the number of stores, this comes down to revenues for around nearly 37 crores per store. On the other hand, considering the fact that Hypercity has a per square feet area of around nearly 13.3 lakh square feet, well, that comes to around nearly 5,255 rupees per square feet in terms of revenue generation. Of course, these are very rough calculations, and we'll have to wait for more details coming out of the press conference, should it be about this acquisition specifically.
All right, thanks for that caveat. 4 p.m. Is when we will hear whether it is about the acquisition or not. Agam, thanks so much. Let's switch to wind power space. Prices have plunged to a record low at the latest auction, where companies bid for contracts worth 1 gigawatt. Rajesh Kumar Singh of Bloomberg News joins us with the details on who bid what, but more importantly, what these low tariffs will mean for the wind power sector. Not entirely healthy.
We have seen record low tariffs in the latest wind auctions in India at a price of 2.64 rupees per kilowatt hour. The auctions concluded today. It's basically a result of the auction policy that the government has taken for setting up wind power projects and bringing down the cost of power in general. It would definitely bring down the cost of purchase of power for the distribution utilities, which are struggling with their finances. However, it also means an increasingly competitive power market in India, and this will bring in more competition for the conventional players, the coal-based and the gas-based suppliers, who will now have to shape up because as they incur more costs to become more environmentally compliant, they will face tremendous competition from the renewable players in the market.
All right, and there's been a lot of fear that these record low tariffs could add to stress in the power sector. Most of it has so far come from the thermal power side. Now it could start coming in from renewable power as well. Speaking of stressed assets, and bad loans continues to be the biggest challenge for the banking sector, says Rajneesh Kumar, the man who's all set to take over as chairman of State Bank of India. Speaking at a press conference after he was appointed, or his appointment was put out in public domain yesterday, Kumar said that it's crucial to segregate NPA management from the daily affairs of running a bank. I'm not sure how you do that when that is the primary concern for the bank, but nevertheless, Vishwanath Nair was at that press conference. He's joining us with some of the takeaways from that interaction. Vishwanath, what did Kumar have to say?
Rajneesh Kumar, who will be taking over as the chairman of State Bank of India from Arundhati Bhattacharya on the 7th of October, has made a few points about what his plan is going to be for the bank as far as the bank is concerned. One important point what Rajneesh Kumar has said is that for the bank of the size of SBI, retail credit growth alone cannot cover for the growth of the institution, and that a revival in the corporate credit will be very important for the bank to grow further. Apart from this, Rajesh Kumar has said that NPA management and stressed asset management will continue to be a top priority. However, he is looking at segregating NPA management from daily affairs of the bank, so that not the entire top management is involved only in stress management. Rajesh Kumar will also try and look at improving the bank's market share in SME as well as agricultural loan books, apart from the retail loan expansion, which the bank is already into. Along with this, the bank is already in the process of a digital transformation, is what Rajesh Kumar has said, and that will continue. And in about 3 years, people will see a completely new type of bank with SBI having transformed into a completely digital bank.
Stressed asset is the top priority for the bank. What is currently happening is that a lot of management time is being spent on resolution of stressed assets and tackling of stressed assets. So banking sector's role will very much be there, but learning from the mistakes or whatever you call it, there is definitely a change in the underwriting standards. That change will be there. We will be much more cautious. Sometimes people equate it with risk aversion, but let me tell you, it is not risk aversion. We are still looking for opportunities in financing good infrastructure projects, and the organizational structure or the people who deal with the infrastructure financing, we are strengthening that our internal infrastructure to deal with infrastructure finance.
All right, that's the new SBI chairman. He'll be at the helm of affairs for the next 3 odd years. Staying with the stressed asset space, actually, KKR is standing ready with enough capital to invest in and restructure some of these bad assets in the market. The private equity firm, however, is still waiting for regulatory approval for its asset reconstruction company. In a conversation earlier today, Sanjay Nair, CEO at KKR India, discussed some of the issues with getting these stressed asset deals through. The big one being that public sector banks don't have enough capital to mark them down to a realistic value. Here and to listen in to a piece of that conversation.
We as a firm, and I know a lot of our other peers also, are ready with real funds, long-term funds that can come into buying bad assets and actually repairing them and making them better, because there are many assets which are repairable. Today a lot of assets are going down under because working capital is being squeezed, banks are not lending. So a poor guy who needs 180-day capital but gets only for 120 days, he begins to become a bad asset slowly, and then you start evergreening these things. So your real problem becomes bigger than actually it is. So there are enough assets available out there which we can buy, repair, create value, not only for ourselves but for the bank, and God forbid maybe even for the promoter if he's got a tail left in it. So, but that time is going very rapidly away because you did not get the assets out in the right time. So a chemical plant that is shut can't be shut for too long yet. I mean, if it's shut for like 3 years, it's pretty much over. So I think that's a big issue. We have talked about fair market price for a long time, but the banks haven't managed to hit that bid because they find that it's below replacement value. Some people find it's below their reserves, whatever the reasons be. And I think we're coming to a point where this problem compounds every quarter. So ultimately, if we're going to do orderly liquidation, then we have no role to play because we're not liquidators, okay? There are enough ways to do liquidation of assets, and that's, I think, unfortunately, where this whole thing might head.
Really? You think that...
No, well, lots of things, ultimately, if you can't recover them, either you'll buy them at the pennies. So let's say we were offering 50 cents to the dollar, it's probably worth 30. By the time the IBC process happens, it's probably worth 20. And if there's no bidders for it, it's probably worth 6, which is what happened last time. So it's, okay, the process will be cleaner, people will feel more secure about it, but you've taken a massive hit here, and you've lost productive assets. So I think you've got to be more dramatic, and that's why a bad AMC or a bad bank is the way to go. And then you use all the fiscal benefit you have and just capitalize the banks. Of course, the best thing is to privatize these banks, but let's not even go that way. Because last time we talked about this, it wasn't, I mean, it's not understood why would you privatize a PSU bank. The question is, why do we own banks?
Let's get back to the equity markets. IDFC Securities has come out with a strategy note, and the brokerage house has turned bullish on ONGC. Darshan Mehta standing by with more details and highlights from that report. Darshan.
So basically, this is the strategy report from IDFC, which was released yesterday. Now, in terms of what they're doing as far as their strategy is concerned, this is the overweight stance that they have: auto, consumer, engineering, media, metals, oil and gas, and pharma. So these are the counters that they are overweight on. There are two sectors that they are underweight on currently, and that's the real estate and telecom. The other sectors like banks and all will be pretty much neutral for them. What is the buy? What is the new buy that they have in their model portfolio? So it's ONGC. So what they're saying, why they like ONGC at this point of time, because it's underperformed the market. The valuation ignores the gas output that will come in, and pretty much the KG-DC basin will boost earnings. So that is why they're positive on ONGC. What goes out at the cost of ONGC is KPR mills, and the reason that they have said is there is uncertainty over the cotton production and lower yields than last year. This is the reason that they've given why they've taken KPR mills out. Now, in terms of their buy list, ONGC, Hero, Motherson, HPCL and Hindalco are the companies that they like. Apart from it, there are other 5 companies also they like. So the counters that they like as far as their large caps are concerned include counters which will come in the next slide. So these are the counters that they like. So Aurobindo Pharma, these are the cells that they have. Bajaj Auto, United Spirits and DLF are the cells, but other counters like Aurobindo Pharma, SpiceJet are the other counters in which they are rather bullish on.
All right, thanks so much for that, Darshan. That's a market take and IDFC's strategy in the market. We're going back to the topic that we started with, and that's GST. The India Economic Forum is underway in Delhi. Speaking there, Adi Godrej, who has always been a strong proponent of GST, said that he continues to hold that view despite all the talk about the disruption that GST has caused in economic growth. Godrej gave the example of his own company and said that producers chose to hold back on dispatches in the June quarter. This should normalize in the July quarter, he said, and help in a revival in growth. Here are what he had to say on a panel discussion hosted by Bloomberg News' Harsha Subramaniam.
We're talking at a time when the narrative of the India story, given the macroeconomic indicators, have turned from being positive slightly to an area of doubt. What is your assessment of what's going on in the economy and the reforms that have already been put in place?
I think the doubt has started when we published the April-June GDP growth figures, which was at a low level of 5.7%. In my view, during April and May, we had reasonable growth. We don't publish monthly GDP growth figures. But in June, we had a rather low growth rate because that was a month preceding the introduction of GST. And in GST, in manufacturing items, there were lower rates than the earlier combination of excise duty and VAT. So obviously there was considerable destocking by the trade, and there was considerably lower production shown. Production might have taken place, but it was not shown.
How can we make reforms that's broad-based and inclusive? We are living in one of the most unequal societies in the world, and reforms tend to benefit already those who have benefited. And I want to specifically point about agriculture. And the case that's before us is agriculture as a job, as a profession, is becoming unviable, unproductive. Incomes are not growing. How does one, create reforms there?
Agriculture is one of the most important priorities for the government because still we have a majority of our population living off agriculture. See, there are so many challenges in agriculture. One was the dependence on monsoons and the risks associated with any crop. The crop insurance scheme, which have been brought in by the government, gives much better coverage in terms of risks, and a lot of people are availing of it. One of the challenges of agriculture is marketing, because if the farmer doesn't get a good price, obviously there's no incentive to produce. Now this electronic national e-market that is being set in motion in about 600 mandis of the country, actually Karnataka is the pioneer in this regard. I think will actually give the farmers a better price. But then the state government has a major role in agriculture. Remember that central government has a limited role in many areas, including agriculture. Perhaps the farmer is the only person in the country who needs a permission to, or who has a restriction to sell his produce.
One of the objectives that you look at is bridging infrastructure investment gaps. We have a large gap here in India. Do you see, and some of the transformative ideas need to come in the area of infrastructure. Would you look at funding something here in India? Is there something that interests you? What is your assessment of the gap that is here?
Okay. Well, and some people, not only necessarily India, but some people think what's missing is the financing. So therefore, those people kind of asking us, can you widening or bring different types of investors such as pension fund or insurance company? However, I have a different view. I think what's missing is not a financing. What's missing is the investable project. What I'm kind of recommending not only India, but also other middle-income countries have a bright future to government, development of financial institutions like us and private investors to work together to identify potential projects that we can work together, especially like identify the project to leverage private investors to invest in, not necessarily using a lot of balance sheet of the government itself.
That's our conversation on the Indian economy, how domestic and foreign investors look at it. Now, most of us measure economic success in terms of GDP growth and such triggers. But increasingly, it is being felt that GDP should not be the only measure. Factors like income inequality should be taken into account. Recently, celebrated economist Thomas Piketty said that income inequality in India is at its highest in a long, long time. Piketty has called that paper From British Raj to Billionaire Raj. Praveen Chakravarti, consulting editor at Bloomberg Quint, is looking deeper into that data and trying to understand whether a part of that income inequality emerges from the salary structures at corporate India. Listen in.
Famous French economist Thomas Piketty showed in his recent research that income inequality in India is at its highest level in nearly 100 years. He says the top 1% of all Indians earn 22% of all income. The top 0.01% earn 4% of all income. Let us try and understand this in the context of the corporate world. Let us assume there is a large company that has 10,000 employees in total. Let's say this company pays 1,000 crores as salary to all its 10,000 employees. The top 0.01% in this company refers to the top person, who will be the managing director or the MD. According to Piketty, this MD earns 4%, that is 40 crores of the total of 1,000 crores in salaries that this company pays, which means the remaining 960 crores is shared by 9,999 employees. That is, in each employee on average earns 10 lakh rupees. So the MD earns 40 crores, the average employee earns 10 lakhs. The MD earns 400 times more than the average employee. This, in a sense, is what Thomas Piketty is saying about income inequality in corporate India. Is this really true? We took a set of 20 large companies, 15 private sector and 5 public sector from various different industries. These 20 companies employed 1.6 million people in total. We collected data for the year 2016-17, the MD's pay, total employee salary, total number of employees, etc. We used only cash salary received by the MD, not stock options and other such compensation that senior executives receive over and above their cash salaries. What did we find? MDs of private sector companies such as Hero MotoCorp, Bajaj Auto, ITC, JSW Steel, ICICI Bank earn 200 to 500 times the average employee's salary. But the MDs of companies such as TCS and Maruti Suzuki earn just 25 times more than the average employee. MDs of public sector companies earn just 3 times more than their average employee. For example, Hero MotoCorp's MD Pawan Munjal earned 60 crores in just cash salary last year. Hero MotoCorp has nearly 9,000 employees. The average Hero MotoCorp's employee earns rupees 12 lakhs. So, its MD earned 500 times the average employee. This is much higher than even Piketty's estimate. There is also a big variation in the pay of MDs of various private sector companies as well as between private sector and public sector companies. Does this mean that larger companies with greater profits pay their MDs more? No. It turns out that the profits of a company are not quite related to their MD's pay. TCS is among the most profitable company in this set of 20 companies, but its MD is paid among the least in this set. Maruti Suzuki is more profitable than Bajaj Auto or Hero MotoCorp, but Hero's MD is paid 15 times more and Bajaj Auto's MD is paid 6 times more than Maruti Suzuki's MD. Okay, if it's not profits, is it the stock price performance of these companies that is a factor in the pay of these MDs? Again, no. MD's cash salary is not related to its stock performance either. Infosys was the worst performer in this set, where its stock was down 16% in the year 2016-17. Punjab National Bank was the best performing stock in this set, up 77% in the same period. But Infosys MD received 40 times more cash salary than Punjab National Bank's MD. Even among its own peers, Infosys stock did worse than, say, TCS stock, but its MD received 3 times more cash salary than the TCS MD. It is thus clear that MDs of large private sector companies are paid more than 300 times the average employee, regardless of profits or stock performance. This confirms Thomas Piketty's findings of high income inequality in India.
All right, that's just a teaser of what is an absolutely fascinating read. It's on the BloombergQuint.com website. Do go there and catch it and read more about what Praveen is talking about. That's a wrap on this edition of Power Lunch. Coming up next, that special conversation with Sanjay Nair of KK India that you heard before. Well, the full conversation coming up on the economy, the investment climate, stressed assets. Stay tuned.